Hey guys, hope you're all good. So I started this finance fitness YouTube channel because I want to break down personal finance and make it easily understandable and accessible to everyone. Unless you studied finance, a lot of these important topics just don't get covered in school, yet we all have to deal with it every day in our lives. So if this is something you're keen on, consider subscribing to the channel. For those of you that know me, know that I'm a big fan of investing in real estate, and I wanted to do a video to break down some of the reasons why. This will be the first of a two-part series where I'll go over 10 reasons why you should consider investing in real estate. So keep an eye out for the next video. Probably the easiest way to do this is to just hit the notification bell so you receive an alert whenever I publish that new video. But before we get into this video, I have a bit of a confession to make. I've been getting all of my information, my ideas, my research from someone in the inside. And it's probably time to come clean. I feel I owe it to all of you to give you the truth. So here is my source. Meet Nana. Do you like finance? Who likes investing in real estate? Okay, so back to the video of today, real estate. Real estate has been a cornerstone of many investment portfolios and an amazing creator of wealth for generations, and it's also been a personal favorite of mine. For as long as I can remember, I've been passionate about investing in real estate. So I bought my first property when I was 23 years old, and since then I've just been adding to my portfolio, and now I have around a dozen properties that I've purchased over the last 9 years, and I rent them all out. Some of them I bought on my own, and for some of them I partnered with others so we could do it together. For me, it's still the most exciting investment to make, way more than buying a stock or a bond or an ETF. I just love it, and I wanted to share with you some of the reasons why. I know that buying a property can be really daunting. I've been there, and in future videos I'll share some tips of things to consider when you're buying a home. So make sure you subscribe to the channel so you don't miss those. So, reasons why I think real estate can be a great investment. So probably the biggest benefit of investing in real estate is the ability to use the money of others, usually the bank, to make that investment. For most of us, if you wanted to go out and buy $10,000 worth of Apple stock, you need to have $10,000 cash ready in order to make that investment. So you take your $10,000 cash and you go out and buy $10,000 worth of exposure to Apple stock. But when it comes to buying a property of say $100,000, you don't need to have $100,000 cash available right now. You only need to have enough for a down payment or deposit and maybe some transfer costs. If you're looking to buy a property to live in, you can probably get away with a 10% deposit or even less, depending of course on your credit score and earnings, etc. So with a 10% down payment of $10,000, you can get exposure to a property of $100,000, and the bank is going to cover the rest of the purchase price through a mortgage or a home loan. And this concept of using debt in order to make your investment is known as leverage. And what's great about this is it can really accelerate your wealth generating process, because you can multiply the exposure that you have to an asset as opposed to if you're just buying it with cash. And this is how I was able to get started in real estate at 23 years old, because I didn't have much money and I was earning peanuts. I did a video where I looked at whether debt is good or bad, and I explored this leverage concept in a bit more detail there. So if you're interested, I have included a link in the description below. Okay, so with leverage, you can get more exposure to an asset. But what does that mean? Well, let's go back to our example of the Apple stock. If you have $10,000 worth of Apple stock and it increases by 10% to $11,000, you've made a total return of $1,000. But compare that to the property example of $100,000, and if that goes up by 10% as well to $110,000, you've made a profit of $10,000. So your return is 10 times as much as the dollar return in the Apple stock example. And this is just one component of your return. We haven't even considered the principal payment of your mortgage or the cash flows, topics which we'll look at a bit later in this video. Over the long term, property prices in the US have increased by around 5.4% each year. Now you may say, Gareth, 5.4% is less than what you'd get if you invested in the stock market, because there, over the long term, you're looking at a 9.8% return. And you'd be right that the 9.8% is higher if you invested in the stock market. But we must remember that with real estate, aside from the price appreciation, you also have cash flows, maybe some potential tax benefits, and of course the leverage that we spoke about earlier. So instead of looking at the return on the total value of the assets, it's probably better to look at the return on the amount of money that you actually invested, the amount of cash that you put into that investment, because then we're comparing apples with apples. So in our previous example, we spoke about an investment in Apple stock for $10,000 increasing to $11,000, and that $1,000 gain is a 10% return on our initial $10,000 investment. But when you compare that to the real estate example, where we bought a property for $100,000 and it increased to $110,000, we made a total return of $10,000. But remember, we only gave a down payment of $10,000 and the rest all came from the bank. So our $10,000 effectively doubled and we made a 100% return. So if we consider that property prices increased by around 5.4% each year, in this example we could basically double our initial cash investment in less than 2 years' time. Every month you'll be making your mortgage payment, and this mortgage payment is split between an interest component and a capital component. Now the interest component is an expense, but the capital component goes towards reducing your outstanding loan balance, and this effectively increases your net equity in the property and increases your wealth. You may have heard before of an amortization table. An amortization table basically just splits your monthly mortgage payment between the interest and the capital component and shows how the outstanding balance amount gets reduced over time. So here is a simple example of an amortization table, where we're assuming a $100,000 loan value at 3% interest and will be paid off over a 10-year period. And in this table we can see that the total monthly mortgage payment is $963, but that's split between a $250 interest component and a $713 capital component. But what you will see in the table is that with each month the interest amount becomes slightly lower, and that's because the total outstanding loan becomes less and less and less, and a bigger portion gets paid towards the capital component of the mortgage. And by the time you get to month 60, you're only paying $137 towards interest, while $826 goes towards capital. So with your monthly mortgage payment, the capital portion is almost a way of forcing you to save each month. This in turn contributes to increasing your wealth and is another great benefit of investing in real estate. Cash flow is a great type of investment return, and one of the reasons that many people are drawn to property. This cash flow increases as your rental income goes up every year, and you would expect your rental income to go up by at least the rate of inflation or maybe even more. This is one of the reasons why many people say that investing in real estate can be a great inflation hedge, because it protects you from the impact of inflation. Yeah, you can increase your rental income by at least the rate of inflation and usually even more, which will then keep up with your increase in your living costs. Also remember that your expenses, insurance, property taxes and commissions would also increase, usually in line with inflation. But this is not the case for your biggest expense, your biggest monthly cash outflow, which will be your monthly mortgage payment. With a fixed interest rate loan, your mortgage payment every month will remain the same over the whole period of that mortgage. Remember back when we had that amortization table and we saw that the monthly payment was $963? That monthly payment remained the same over the full 10-year period. So your income is increasing by at least inflation, while your expenses increase by less than inflation, and this has an overall positive impact on your monthly cash flow. Now, some countries have higher inflation rates than others. For example, in the US, they have an inflation target of around 2%, and in fact for many years now they've been below that 2% target. Compare that to South Africa, where the inflation is probably around 4.5%, so this is more than double what it is in America. So what does a higher inflation rate mean for your cash flows when you're investing in real estate? Well, if you're investing in a property in the US, you may want to make sure that you're achieving a positive cash flow from day one. You can do this by locking in a good interest rate, a good purchase price, and maybe achieving good rentals. Because with a low inflation rate, it would take very long for your rental income to increase enough to turn that negative cash flow into a positive cash flow. Compared to a property investment in South Africa, where you may be willing to accept a slight negative cash flow at the beginning, knowing that with a higher inflation rate, it won't take long for your rental income to increase and turn that negative cash flow into a positive cash flow in a fairly short space of time. Then there is another great surprise down the road when it comes to cash flow, because after years of paying your mortgage, eventually the remaining balance will be zero and you would have totally paid off that property. And when that happens, all of a sudden your biggest monthly outflow will no longer be taking place and you'll see a big jump in your positive cash flow every month. So this can be a great longer term strategy to drop your monthly costs, making it easier to achieve financial freedom because you need less income every month to cover those costs. Investing in real estate is scalable, and you can really scale at a pace that works for you. Let me show you what I mean. Let's say you plan to buy one property every 2 years until you get to a point of having 5 properties and then you stop. And let's just, for simplicity, ignore inflation for this example. Let's assume that when you buy each property, it will generate $100 a month of positive cash flow, meaning that the rental income minus all the costs of mortgages, insurance, property taxes leaves you with $100. $100 a month is very achievable and maybe even conservative in some cases. So you go out and buy property A and it generates $1,200 in the first year. Then at the end of year 2, you go out and buy property B, which also generates $1,200 a year. So in year 3, you're getting $1,200 from property A and $1,200 from property B, giving you a total of $2,400 for that year. And as we repeat this process of purchasing more properties, we can use that positive cash flow from all of them and pay down outstanding mortgages. And this will mean that we'll pay down those mortgages ahead of time. Imagine if we take the positive cash flow from each of those 5 properties and pay it towards property A's mortgage. It won't take long before that mortgage is completely paid off. And when this happens, the snowball effect really starts flexing its muscles because we see a nice increase in our cash flows every month. Now we're only paying 4 mortgages instead of 5 on our 5 properties. And this means that we now have a larger positive monthly cash flow, and we can go ahead and use that to pay down the mortgage of property B until it is paid off. And once property B is paid off, we now have 5 properties generating positive cash flow and only 3 mortgages remaining, which means our positive cash flow increases by even more and we can pay even more towards our remaining mortgage balances. And so the snowball grows and grows. And once the final mortgage is paid off, you now own 5 properties without any debt. And if you assume that you can get around $1,500 a month in rental income for each of them, and you have expenses of insurance, property taxes, and maybe commissions of say $500 a month, each property can be net positive cash flow $1,000 a month. And since you have 5 properties, we're talking about $5,000 a month for only making investment every 2 years. And this is just one example. Maybe you want to own 20 properties or 200 properties or maybe even thousands of properties, as we've seen many people do in the past. Maybe you don't want to pay down all the debt and want to continue to use the power of leverage, or maybe there's specific tax considerations in your country. All of these are factors for you to consider. But this example shows a pretty realistic and achievable way to grow your wealth and generate a passive income on the side. So, do any of these reasons resonate with you? Why do you like to invest in real estate? Like I mentioned earlier in this video, this is a 2-part series, so make sure you keep an eye out for next week's video where I'll go through another 5 reasons of why I love investing in real estate. Also, you can follow Nana and I on Instagram, and here is my handle. And that's it for the video today, guys. I hope you enjoyed it, and if you did, make sure you hit the like and subscribe buttons. I'll see you next week.